Hey everyone, get ready because what I'm about to tell you is a huge deal. Something that hasn't happened in almost 30 years. We're talking about a massive shift in how the world's money works. For the first time since 1996, foreign central banks are now officially holding more gold than US government bonds. Let that sink in for a moment. This isn't just a small change. It's a monumental signal about the future of your money, the power of the dollar, and what's really bubbling beneath the surface of our global financial system. You absolutely need to understand this, so stick with me as we unpack exactly what this means for you, your savings, and your investments. Global central banks have been buying gold at a serious pace for about 10 years now, and this trend has really sped up recently. This aggressive gold buying isn't just a random act, it's actually accelerating the end of the dollar's very special role as the world's main reserve money. It might sound unbelievable, but the total amount of money held in dollars by these central banks is expected to drop well below half in just the next couple of years. This means gold is positioned to return as the most important backup asset, just like it was in times past. We're talking about a fundamental shift back to a gold-backed world in many ways. You can already see the financial system adapting to this. Regulators are now letting banks hold gold as part of their capital, treating it as a stable asset. It's even being used as backing for complex financial agreements. So, why are we seeing this dramatic move away from the dollar? Unfortunately, a lack of financial discipline right here in the US, combined with obvious problems in how Congress is managing our country, is slowly but surely eroding global confidence in the dollar. This entire movement really picked up steam initially with countries like China and Russia, who established the Shanghai Gold Exchange all the way back in 2002, laying the groundwork for this shift for years. What this means for our country is profound. It puts the United States in a position where we're going to become like everyone else. We're heading back to a market where many different currencies compete, and we'll have to fight for our economic standing, just like other nations. This is a huge departure from the past when the US dollar held unquestioned dominance. We simply don't have the same level of confidence or credibility that we did 50 years ago. And unfortunately, our politicians are actually speeding up this process rather than slowing it down. Some even suggest a weaker dollar is desirable. This is a fundamental change in how the world views and uses the dollar, and it's happening faster than many expected. It essentially brings an end to the dollar's special status. Many people are actively looking for alternatives to the traditional system, and some are flocking to cryptocurrencies. Crypto is often seen as an escape from a financial system they feel is faltering, especially with growing worries about rising prices and massive government spending. Some politicians are even supporting crypto, which could potentially hurt the dollar's value even more. But while crypto has certainly seen some people make a lot of money, it's widely considered by many experts to be a short-term trade, perhaps just a passing fancy. Those who have truly protected their wealth for generations often tell us that genuine, lasting wealth protection is found in tangible assets like gold and real estate. Remember, the dollar is still legal tender right now. You can buy groceries with it. Crypto isn't quite there yet, and making it so could potentially bring us back to a chaotic time for money in this country, much like before World War I, when we had a very messy currency system. Now, let's talk about our banking system because there are some serious issues brewing. For a while, banks seemed to be sailing smoothly, especially since the pandemic hit. When the Federal Reserve dropped interest rates to zero, it also made the apparent cost of borrowing money incredibly cheap. You can still see the effects of this in home prices, which have remained incredibly strong. The default rates on mortgages for single-family homes owned by banks are essentially zero. That sounds fantastic, doesn't it? But here's where the real trouble lies. Commercial real estate and apartment buildings are facing serious problems. We're seeing 100% losses on those loans when they default. This is a massive, silent problem that is quietly building beneath the surface of the financial world. On top of that, the Federal Reserve is still actively shrinking its holdings, or
what they call their balance sheet, even though they're not fully sure what the overall impact will be. That uncertainty is frankly quite scary, and it raises big red flags. We could easily see another market downturn or a big sell-off just from the Fed's actions alone. There's also a huge credit risk for banks coming from financial companies that aren't traditional banks. We're talking about over $1 trillion in loans to these groups, plus another about $4 trillion in unused credit lines that could be drawn upon at any time. You can see warning signs of this playing out in the stock market. When you observe stock prices racing ahead and a lot of private investments being pushed onto the public market, often because the original private investors don't want them anymore, it tells you there's a problem with underlying value. And that problem may very well get corrected sooner than later, potentially leading to a sharp market adjustment. So, what should you do with all this information? The most important thing is to be cautious and smart with your money. Take a hard, honest look at your investments, especially those that were primarily driven by pure momentum and excitement over the past couple of years. Ask yourself if these are assets you truly want to hold on to in a potentially more volatile market. Many smart money experts are shifting their focus to more defensive investments, like those tied to solid mortgage investments, and concentrating on assets that produce steady income, like government bonds and special company shares that pay regular income. These offer stability when other areas of the market are shaky. Even big names in finance like Jamie Dimon are loading up on short-term government bonds, which strongly suggests they expect interest rate cuts very soon, whether those cuts are planned or forced by market events. There's also very real concerns about banks that have a lot of loans on apartment buildings, particularly in big cities like New York. Aggressive new policies are making it incredibly difficult for property owners there, and this could cause significant problems for some banks. It's important to remember that inflation is pushing millions of people to the financial brink, making places like New York incredibly expensive. And this desperation can fuel radical political ideas that further complicate the economic landscape for property owners and, by extension, banks. And what about gold? Gold remains a core and essential part of many investment portfolios. It's no longer just an asset sitting idly. Today, you can actually borrow against it. This makes it a very flexible and increasingly important part of your holdings as we move forward through these uncertain times. It offers a unique blend of stability and liquidity. We could see a significant sell-off in stocks at some point, potentially even worse than what we experienced in April of this year. And on the housing front, a price correction is very much on the horizon, possibly around 2028. Many experts predict prices could come down to about 2020 levels. That's not necessarily the end of the world, and in fact, it would actually help affordability, allowing more families to get into the market who can't afford to right now. The Federal Reserve's actions after COVID, when they bought huge amounts of mortgages, artificially pushed home prices up by 40%. They still own about 20% of all mortgage investments, which has kept home prices artificially high and affordability stubbornly low. While commercial real estate is already starting to see corrections, residential real estate is widely expected to follow suit in the coming years. Despite all these challenges and shifts, the good news, believe it or not, is that the world still wants to believe in us as a country and still wants to do business with us. It's going to be a wild ride, so make sure you're prepared and well informed. Staying on top of these trends is your best defense. Don't let these monumental shifts catch you off guard. Take control of your wealth, understand what's happening, and be ready for whatever comes next. If you found this information valuable and eye-opening, please hit that like button, subscribe to the channel for more crucial insights, and ring the notification bell so you don't miss our next important update. Thanks for watching, and I'll see you next time.